So, Rogers Communications. It's a name you've probably heard, right? But what about the puzzle at the heart of its stock? It's a story that's got analysts and investors, well, pretty divided. And today, we're going to unpack exactly why.
Okay, and right here, this is the core of the whole thing. You've got what the market says the stock is worth, and then what at least one analyst believes it's truly worth. And that massive gap between the two? Well, it hints that this stock might be seriously undervalued. The big question is, what's causing that disconnect? This quote from the analyst report just nails the whole paradox, doesn't it? You've got this core business that's kind of just plodding along, but then the stock looks cheap, and there are these areas for excitement that might just be the most interesting part of the whole company. All right, so let's dive into that paradox. How can a company that's just plodding along be seen as a potential bargain? And look, the market has its reasons for being a little down on the stock. According to the report, it's not just Rogers. All of Canada's big telecom companies have seen their stocks take a hit. They're all dealing with this really tough competitive environment that's only getting more intense thanks to new government policies and regulations. So, to really get what's going on with Rogers, we've got to take a look at the battlefield they're fighting on. You know, for the longest time, the Canadian market has been ruled by the big three. That's Rogers, BCE, and TELUS. Together, they control a whopping 85% of the wireless market. But now, there's a new challenger stepping into the ring nationally, Quebecor, and they're coming in swinging with a pretty disruptive game plan: lower prices. So, the bears, the folks who are skeptical, they're pointing to some pretty big headwinds. First off, Quebecor's aggressive pricing puts a cap on what everyone else can charge. Then, you've got the government, which is really pushing for more competition, even making the big guys lease their networks to smaller rivals. And on top of all that, the market is already pretty saturated, so just finding new customers is a massive challenge.
Okay, so keeping all that competitive pressure in mind, let's peel back the layers and look at Rogers' core business. You know, the engine that actually keeps the lights on.
This chart breaks it down for us really clearly. More than half of all the money comes from their huge wireless division. Then another 38% or so is from cable, home internet, TV, that kind of stuff. And that little slice for media, well, it might look small, but trust me, it's a lot more important than you think. We'll get to why in just a bit. And this is what they mean by plodding along. The report is forecasting that the giant wireless part of the business, it's only going to grow maybe 2 to 3% a year. And the cable business, basically zero growth is expected. So the main engines of the company are just running at a really slow, steady pace. So you might be thinking, with all that competition and slow growth, how does Rogers even defend itself? Well, it has something called an economic moat. It's kind of like the moat around a castle. For telecoms, the cost to build a whole national network from the ground up is just astronomical. So that super high barrier to entry gives Rogers a, quote, narrow but still really important advantage against any brand new competitor. Okay, but now let's talk about those areas for excitement, because this is where the story gets really interesting and where we start to see what the market might be completely overlooking. A lot of people actually don't know this, but Rogers has been quietly building a sports empire. I'm not just talking about TV stations. They own the Toronto Blue Jays outright, and they have a majority stake in the company that owns the Maple Leafs, the Raptors, Toronto FC, and the Argonauts. I mean, that is an absolutely staggering collection of powerhouse sports teams.
And right here, this is the core of the bull case. The analyst is basically saying these iconic teams are trophy assets, and they're worth way, way more than what the company's books say they are. I mean, think about it. We live in a world with a million streaming options, right? But live sports, that's one of the few things people absolutely have to watch live. That makes them incredibly valuable. So while the market is seeing a slow-moving telecom company, it might be missing a whole treasure chest of priceless sports assets.
So when you weigh the slow, plodding core business against this hidden sports empire, what's the bottom line?
The analyst's fair value estimate comes out to $70 Canadian. And this isn't just a number they pulled out of a hat. It's a projection of what they believe a single share is really worth based on all the future cash the company is expected to make and its long-term potential. And that stands in pretty stark contrast to where the stock has been trading recently at around $49. According to this analysis, that suggests a potential upside of over 40%. That's a big difference.
So let's just lay it all out, the two opposing sides. The bulls, they see a stable business that's priced like it's shrinking, these incredibly undervalued media assets, and the power to bundle services together. The bears, on the other hand, are worried about Quebecor dragging down prices, the constant threat of more government regulation,
and a cable business that really has nowhere to grow.
And that really brings us back to the big question, doesn't it? Is the market right to be so focused on the headwinds and the slow growth? Or is it so fixated on all those challenges that it's completely missing a potential treasure, just hiding there in plain sight?